Welcome to Bloomberg Markets. I'm Scarlett Fu. Evidence of a resilient U.S. economy cues traders to lower their expectations of aggressive rate cuts this year. How is that showing up in financial markets? It is risk on. Stocks are gaining. You've got big cap stocks, big tech stocks, and also small caps all advancing thanks to the bigger than expected gain in July retail sales. You can see the Nasdaq here leading the way up 2%, but small caps doing even better, higher by 2.5%. We also have the retail sales report lifting oil for the first time in 3 days. NYMEX crude gaining almost 2% to $78.44 a barrel. Now, as part of this risk on trade, treasuries are declining, which is pushing yields up. Shorter duration in particular leading the way. You're looking here at the 2-year yield, which is very sensitive to Fed policy. At one point, the 2-year rose as much as 15 basis points, almost 16 basis points. Now, from macro to micro, here are a couple of the big equity movers we're keeping an eye on. Cisco shares surging for their best day in more than 4 years. This after the company gave a bullish revenue forecast for this quarter and announced plans to cut thousands of jobs as part of a larger strategy shift. Meanwhile, you look at Walmart stock, it is perched at a record high, currently up 6.5%. That's not a daily move for Walmart. This after raising its full year sales guidance, despite warnings from economists and investors alike that consumer strength is starting to slow. If you look at Walmart's e-commerce sales in the U.S., that grew 22% in the quarter. And sticking with retail, Nike also higher by 4%. Bill Ackman's Pershing Square disclosed a new stake in the sportswear company. A 13F filing showed that Pershing holds about 3 million shares in Nike, worth almost $230 million. Now, outside of retail company news, the government today said U.S. retail sales accelerated in July. Earlier today, we caught up with Tom Porcelli from PGIM Fixed Income. He still sees weakness in the consumer, even with these positive headlines.
You are starting to see delinquency rates on the rise. Modestly, but they're rising. You are starting to see the unemployment rate rise. Again, it's still relatively low, but it's up 0.7% at this point. So I think you're starting to see some of the tight policy now start to show through.
Nonetheless, the headline retail sales number did come in stronger than expected, and markets are recalibrating their expectations for how the Fed proceeds with rate cuts this year. So putting this all together, we'd like to bring in now Crossmark Global Chief Market Strategist Victoria Fernandez with more. Hi, Victoria. It's good to see you. Let's just take a step back here for a moment. What does this week's data, and here we're referring to PPI, CPI, and retail sales this morning, mean for the growth scare narrative that was really starting to take hold after last Monday?
Yeah, I think, Scarlett, when you see the reaction that the market has had, you can tell that it's taking a little bit of a breather and saying, OK, maybe we're not headed for the recession or the hard landing that was anticipated a week ago, more of a soft landing. But I think a lot of it has to do with the repricing of what the Fed is going to do. You had a lot of people calling for emergency meetings to lower the Fed funds rates, asking for 50 basis points in September. I think we had priced into the market 4.5 cuts from now till the end of the year. Some of that has been repriced as CPI was a good number, but there were some elements that tell us there's still some sticky inflation. So maybe the Fed needs to, kind of walk before they run. Retail sales, again, strong. So the consumer is still there. Fed won't want to lower rates too quickly and stoke more demand to keep inflation high. So I think they're saying, all right, a 25 basis point cut in September is probably what the market is rallying around, assuming that is the first in a few steps. We'll see if the Fed delivers on that in a few weeks.
Yeah, absolutely. And I'm glad you mentioned how at one point the market was pricing in 4, maybe 5 rate cuts for this year. Right now, it's about 92 basis points. So that's just under 4 cuts. I know that before the inflation data, Victoria, you were anticipating 2 rate cuts. So talk to us about how you see those rate cuts playing out, because the market seems to think that there might be a supersized rate cut still in there for 2024.
Yeah, the market does. And I'm a little surprised because there are some, kind of pushing and pulling in the markets right now with some of the data. You do have things that are saying, look, the economy is doing well. Atlanta Fed GDP at a 2.9% for the next quarter. Again, equity markets doing well on the rebound. They had a quick reversal. Retail sales good, but there are some warning signs as well. The JOLTS report is telling you maybe there is some weakness in that labor market when you start digging down there. Regional Fed surveys today were negative. Manufacturing, we know, is negative. Industrial production is poor. So I think the Fed is going to go very slowly. I do still anticipate 2 rate cuts. I think we'll get the first 25 basis point cut in September. The market will probably be okay with that because I anticipate next Friday at Jackson Hole, Powell will start to lay the groundwork for that, so it shouldn't be a surprise. And then I think we get the next one in December.
Okay, and I'm glad you bring up Powell because certainly that's the thing that everyone's kind of watching for. What do you think will be the catalysts in between that speech from Jay Powell at Jackson Hole? I mean, is it going to be Fed speak, which feels like it'll be less important given that Powell will be speaking soon? Is it going to be NVIDIA's earnings report next Wednesday?
Yeah, I mean, obviously, NVIDIA's earnings report is going to be key. It is the driver of the market in the first part of the year. They have had a huge pullback, so I would anticipate that if they report strong earnings, we'll see these tech names start rallying again. They have this week. I mean, I think NVIDIA's up, 10% this week already. So I would anticipate that, yes, that could be something to continue to drive some of those tech names, some of the risk-on elements of the market. But yet we've still got to look, Scarlett, at some of the things that are telling you to be guarded. You've got high beta versus low beta. You've got Bitcoin, both of their charts in a dark cross, right? 50-day moving below 200-day, which is very risk off and less liquidity in the market. So if you're looking at triggers, NVIDIA could be important. I think you do need to watch some of the liquidity elements in the market and what's happening there. Earnings is coming to a close, but we'd get another jobs report and more inflation before the next Fed meeting. Obviously, all of that will play into the decision.
Absolutely. What is your takeaway from earnings season thus far? I mean, you said it's pretty much over. We know big tech didn't really deliver the high-flying expectations that investors had placed on them. But what about the industrials complex? What about the companies that are exposed to the consumer so far?
Yeah, you know, it's really interesting because if you look last week, consumer discretionary was your worst performing sector, which probably didn't surprise anyone. And we were concerned about the consumer, concerned about the labor market and wages. But yet industrials was your best performing sector. You wouldn't expect that if you're expecting a slowdown in the economy, but they seem to be doing pretty well. Deere's report was pretty strong. Cat was okay. So I think there's some different elements in this market that are giving conflicting stories. But saying that, with some of the tech names and the runs that they've had, I think you should go in and trim some of those names and get a little bit of defensiveness in your portfolio from now till the end of the year. Look at some of the staples, look at some healthcare names, even some of the financials. We've seen those names come back over the last couple of days. Could be an opportunity.
We're seeing today stocks rally and bonds fall. This is a dynamic that was clearly missing when the Fed began raising rates in 2022, and both asset classes tumbled. What is your confidence that we've returned to this traditional inverse relationship between stocks and bonds?
Yeah, I'm not sure that I would say with 100% confidence that we are here and it's going to stay this way. Because of all the things we've been talking about, because of some of the red flags in the economy, I think there can still be a lot of turning and a lot of volatility from now through the end of the year. And it's not just what the Fed's doing and what other central banks are doing. You've got geopolitical issues that are here. We've got a presidential election that could be quite controversial from now through the end of the year. So there's a lot of elements there that can cause some choppiness. So as long as we stay with good news is good news and bad news is bad news, we'll have this relationship. If it starts to revert back because there's concerns that the Fed is not going to cut rates quickly enough for market expectations, we'll start to see that relationship change again.
Yeah, good news is good news for now, but we've seen this get scrambled quite a bit over the past week. Crossmark Global Chief Market Strategist Victoria Fernandez, thank you so much. Coming up, a closer look at China as the country reports mixed economic data and Alibaba disappoints on earnings. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Overnight, we got fresh data on China's economy. The new numbers showed that the country's economic malaise extended into the third quarter. Bloomberg Economics chief economist Tom Orlik joins us now from Washington. So, Tom, it was pretty much a data dump out of the country that spans the industrial economy to the consumer economy. What did we learn overall?
So, not an impressive set of numbers out of China, Scarlett. We had industrial output missing expectations. We had investment missing expectations. And we had retail sales slightly beating expectations, but still coming in at a pretty dismal pace. What does this all tell us? Well, it tells us that the drag from the property slow motion collapse remains considerable. Property sales down more than 20% year on year. And the steady drip of stimulus, which the PBOC and the Ministry of Finance are injecting into the economy, well, that's staving off a kind of an outright collapse, but it's far from sufficient to restore robust growth momentum.
Yeah, far from sufficient is pretty telling there. So when it comes to government response, for anyone who is looking for any kind of big, showy fiscal stimulus, is that pretty much waiting for Godot?
So certainly there's no bazooka, Scarlett. The hope is that there's at least a lot of water pistols. So the People's Bank of China have cut interest rates by 20 basis points. We think they'll do another 10 basis points by the end of the year. There's some fiscal deficit spending still to come. Enough to finance a bit more infrastructure spending. And the PBOC has said it's going to flex its balance sheet to finance loans from state-owned banks to buy up some of that enormous inventory of unsold property. So they've done a bit. There's a bit more they can still do. What's the impact of that going to be? Well, if they succeed, I think it's maintaining a tepid pace of growth into 2025.
Yeah.
That's the upside. If they don't do enough, then we'd be concerned about a renewed slide.
So, Tom, if you take a step back, it just strikes me as curious that, you know, the rest of the world emerged from the pandemic dealing with inflation, rising prices. But China came out of the pandemic, and I know it came out on a different timeline than everyone else, and there's talk of potential deflation. Why is there such a stark difference?
So it's a really great question, Scarlett. I think I'd point to a couple of factors. So the first is the pandemic kind of really put a kind of exclamation mark on some of China's biggest problems. Chief among them, oversupply. And when you've got an economy which is oversupplied, as we saw in Japan over past decades, that really weighs on prices. So that's the first factor.
Yeah.
The second factor is, why did the US come out of the pandemic pretty strong? Well, because they put a lot of stimulus into the economy.
Okay.
Huge fiscal stimulus, starting with Trump, extending through Biden. That also lit a fire under prices.
Yeah.
China, because it's got this problem of high debt, didn't do so much on stimulus, and that's why their challenge now is not soaring prices, it's slumping prices.
So the U.S. brought out the bazooka, in other words. Bloomberg Economics chief economist Tom Orlik, thank you so much. Now we're going to stay with the Chinese economy and hone in on one part of it, which is retail, e-commerce specifically, because Alibaba reported that its Chinese commerce business shrank for the first time in at least a year. Bloomberg's Peter Elstrom has the details. He joins us now from London. Peter, I mean, when I was looking at these Alibaba numbers, what really jumped out at me was 4% revenue increase. That is the slowest pace of more than 1 year. Does this tell us more about Alibaba's struggles specifically or about the Chinese consumer struggles?
Well, it's a good question. Alibaba is something of a bellwether for the Chinese economy. Because of their big e-commerce company, they give us some insights into how the Chinese consumers are feeling at this point, how much they're spending. Yesterday, we got results from Tencent, which gave us a little bit of an insight. But today, we really got more with Alibaba. And as you say, the e-commerce business shrank about 1% this quarter. That was a pretty poor result. It was certainly disappointing for investors. Overall, the top line grew a bit more, the 4%, because of some strength in other other businesses, including the cloud computing business, where they are getting some growth there. Also, their international operations are growing a bit more rapidly. But this sign of weakness in the Chinese consumer and the Chinese consumer spending in particular is a bit of a concern for the company and more broadly for the economy.
Yeah, absolutely. And you mentioned the cloud business. You can't talk about the cloud in the U.S. without pivoting to AI, or at least that's what the companies want to do constantly. To what extent can AI products save Alibaba's cloud business in terms of really becoming a driver for growth here in a way that maybe is not priced in yet?
Yeah, these are early days for AI investments globally. I mean, certainly for the Western companies, I'd say the Chinese companies are a couple steps behind them in terms of investments. So Alibaba is putting a lot of money into their AI capabilities at this point. They're trying to incorporate some of that into their various businesses around the company. The cloud computing business is growing a bit, but one of the concerns, overall operating margins did shrink. They went from 18% a year ago to 15% this year. That's partly because they are investing so much money in AI. And on the conference call, the earnings call afterwards with analysts, the CEO, Eddie Wu, was asked the question, are you going to continue to invest at this kind of pace in AI? And he said, we are. We're determined to kind of make progress in AI and invest. That also is a cause for concern unless they can find some sort of payoff at the other end of these big investments.
Yeah, exactly. We've seen that that game play out here in the United States when it comes to the big tech companies and their capex on AI. You mentioned Eddie Wu. Obviously, he's the CEO, new CEO, and Alibaba is in this reorganization mode. What is his playbook, and does it differ significantly, meaningfully from his predecessor, Daniel Zhang's?
Yeah, Daniel Zhang was pretty focused on expanding in a number of areas adjacent to the core e-commerce business. He made a lot of acquisitions, a lot of investments that were adjacent in things like brick and mortar retail, in new kind of retail ventures. In particular, they expanded abroad also. Eddie Wu and Joe Tsai, who's now the chairman of the company, also are much more focused on the traditional businesses that really matter to them. E-commerce in China is the core. That's the heart of the business. They have to make that successful. That's why the shrinkage was kind of a concern. In addition to that, they see a lot of opportunity in cloud computing. If they're able to add some corporate customers on top of that, then they may be able to benefit. Beyond that, they're trying to sell off some of these assets. They've sold off some of their holdings. They're looking at some other spin-offs, too. They've talked about how they want to focus on those core businesses, and therefore they'll be able to get some value out of that going forward. That's the plan anyways.
Okay, so clearly a company in transition. Peter, really appreciate your joining us. Peter Elstrom, usually based in Tokyo, but in London for the week. Thank you so much. Coming up on Bloomberg Markets, flexible work arrangements are getting normalized, including for Starbucks' incoming CEO. We've got more on that. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Well, chalk up a win for the work from home crowd because just this week, Starbucks appointed a new CEO, Brian Niccol, poaching him from Chipotle. But when he takes over next month, he won't be in Seattle. Instead, he'll be working from Newport Beach, California, where Chipotle is currently based. Let's discuss all of this with Bloomberg opinion columnist Beth Coet. So, Beth, Starbucks is letting its incoming CEO essentially work from home. It's one thing if you're running a tech company, you've got a lot of software programmers working from home themselves, but this is Starbucks, so I was kind of shocked.
So interestingly, he's not relocating from California, but he will be working out of Seattle. So part of it is going to be commuting regularly. But the terms are kind of unclear. I don't know how often he's going to be in Seattle, even though that they're saying that will be his main office.
Yeah, exactly. And apparently he will be commuting to Seattle and travel as needed. That as needed leaves a lot to the imagination. As you said, we don't have the details yet. That's an awful lot of flexibilities that we know most companies aren't offering to their rank and file employees.
Absolutely. And I think it shows how much Starbucks really wanted to get Niccol to join the company. I think it was one of a couple of concessions they made. And interestingly, when he joined Chipotle, Chipotle was willing to relocate the entire company headquarters for him to California from Denver. So I think it's just one of those aspects. If you're that desirable, you can kind of make whatever arrangement you want.
Okay, so this is a Brian Niccol thing more than anything else, more than a Chipotle or Starbucks thing. Like, he can call the shots here in terms of where he wants to work, and the companies will move to him. Got it. Okay. And yeah, as you point out, it speaks to how desperately or urgently Starbucks wanted nickel. Meantime, you look at another big household name company, and the remote work debate got extra heated when Eric Schmidt, who formerly ran Alphabet, I think it was called Google back then, said that his former company is losing the AI race because of its remote work policy. Can you just highlight for us exactly what he said? And by the way, who he was saying this to?
Sure. So this was at a conversation he was having at Stanford. It was a talk or a lecture. I don't think he really meant for it to go public like that. Since his comments have come out, the video has been taken down, and he actually has walked them back. But he was basically saying that the company is struggling to compete in AI because it has these flexible work arrangements. And his argument is, how can you sort of behave and compete like a startup if people aren't willing to work that hard? So he's sort of equating here, willingness to work hard with remote, which I think is sort of really is pretty reductionist, and I think made a lot of people angry.
Yeah, absolutely. It made the Alphabet Workers Union, which represents about 1,000 employees in the U.S. and Canada, really upset because they put out a statement on X saying flexible work arrangements don't slow down our work. Understaffing, shifting priorities, constant layoffs, stagnant wages, and lack of follow-through from management on projects. These factors slow Google workers down every day. So they had a laundry list of issues that they say may be the bigger problem. I mean, Alphabet's no longer a startup. So how can you put startup-type expectations on employees if that's the case?
I think that's such an important point. And I think it's also worth noting that a couple of the most successful AI startups do have hybrid work arrangements. So I think, again, using remote, flexible, hybrid is an excuse for maybe deeper cultural problems that the company might be having. And to your point, it is not a startup anymore. And expecting it to behave that way, I think, sort of sets it up for failure. It's just not possible.
Yeah, and as you mentioned, a lot of tech companies do have hybrid work policies. I believe Alphabet itself has a policy of working in the office 3 days a week. So it's not as if people are never in the office. They're following the rules.
Right, exactly. So I do think that there does seem to be a bit of a generational divide here. And I think that a certain segment of the population wants a return to the way things were, seems to think that any issue that arises is an easy fallback. And I do think that it's going to be interesting to see what happens at Starbucks, right? Like if the company struggles and Nickel can't turn things around, people might turn to this and blame his work arrangement here.
Yeah. Well, it didn't happen at Chipotle, so he has the experience to fall back on where it's not going to happen to him at Starbucks. Beth, always a pleasure speaking with you. Beth Coed, Bloomberg opinion columnist who writes about work issues, culture issues at companies. You can find her work on Be Opinion Go on Bloomberg. Coming up, Dana Telsey joins the show following that unexpected jump in U.S. retail sales. We'll get her read on the economy and on companies next. This is Bloomberg. Welcome to Bloomberg Markets. I'm Scarlett Fu. So it's midday here in the U.S., and we had a retail sales report that was much better than expected, and good news was interpreted as good news for the markets. You have equities at session highs right now, with the S&P 500 gaining 1.5%. Big tech doing even better, with the Nasdaq 100 gaining 2.3%. And we see bonds tumbling, so that is pushing yields up. The 2-year in particular, much more sensitive to what the Fed does next, which everyone is pretty much at this point pricing in a 25 basis point rate cut. The 2-year 4.09%, just a hair under 4.10%, and the 10-year yield at 3.92% at the moment. But let's go back to equities because there are a couple of notable movers there, and Abigail Doolittle has them for us. Abigail.
Well, clearly this mover, Scarlett, is not one that's boosting the indexes to these highs, up more than 1.5%, as you were mentioning. Sega Technologies down 27%, actually off of the lows. Right now, this is the worst day since 2015 for the antiviral maker. At the lows, down more than 40%. At that point, the worst day ever since the company traded publicly going back to 1997. This as their MPOX study failed to meet the goal. The company's pushing back, saying there were some unusual circumstances around it, such as folks who were enrolled in it it already being 1 week into their case of Mpox and that they were within a hospital. But investors clearly not liking this. A piece of it could also be into this. The stock had been up 129% on the year. Clearly expectations for this binary event to go the other way, and then it went this way. Now, this could be bad news for SIGA Technologies, but let's take a look at another antiviral maker, the shares of GeoVax, up 5.2% on the open on the news, that negative news for SIGA. This stock had been up 30% at this point. They are also working on an Mpox vaccine. Taking a look, though, at some of the stocks that are working and helping out those indexes that you looked at, take a look at the shares of Walmart, up 6.6% at the highs. The stock had been up closer to 9 or 10%, something along those lines. At that point, the best day going all the way back to 2020. That was the degree of the buying power. This, of course, after they put up a really a good quarter. They also raised the full year view to as much of 4.75% growth versus the prior view of 4%. And it's a case, really, Scarlett, of consumers hunting for bargains, even high-end consumers. People really focusing on necessities and groceries. E-commerce, a big point of their story, up 22%. And then, of course, we have some of these other Target and BJ's reporting next week. Home Depot hanging on to the gains from its report earlier this week. So overall, retail doing really pretty well.
All right, good stuff. Abigail, thank you so much. You mentioned retail, you mentioned Walmart. Here's how executives are responding to potential weakness that we're seeing in the consumer.
Pricing has been going up. We're guiding in Q3 and Q4 for prices to go up.
As we're taking in new bookings, which we get to see each and every day, the willingness for our guests to pay more for those experiences.
Pricing will absolutely go up in both quarters, and it looks that way for 2025 certainly as well.
They're willing to pay it, and they're also willing to book much further ahead.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
As Abigail was just telling us, Walmart shares at an all-time high today. The company boosted its full-year sales and profit outlook. Pretty much a bullish call, as peers have been warning of a weakened consumer. So for a deeper dive into Walmart, I want to bring in Bloomberg Intelligence senior analyst Jennifer Bartashis. Jen, what was the most encouraging part of Walmart's results? How much can we really read into this being a Walmart story versus a broader consumer story?
So I think some of the most encouraging things that we took away from the call this morning is that it's the second quarter in a row where they've talked about higher income consumers coming into Walmart, but more importantly, that they feel that they now have the framework to keep those customers even after the economy starts to get a little bit better. So historically, when people are challenged, they flood into Walmart, but then as things get better, they leave. So if they're able to hold on to this new cohort of consumers that they're getting, that's really good news for the long-term growth of the company.
Yeah, they want to reduce that churn. It's like a cable provider not wanting to give the customers they sign up because there's a new show available. What about the advertising business? Because we know that Walmart bought Vizio and it's trying to leverage its big customer base into something that can, really kind of smooth out its earnings, its revenue and its earnings over time.
Yeah, the advertising business is doing very well. Walmart Connect, which is the name of that business in the United States, continues to grow in the low 20%. And it's really a sign that they're able to engage with their partners to bring advertising revenue into the company. From a profit perspective, this is great because they're looking at multiple businesses that have much higher margin, and that changes the business mix of the entire company and makes it overall a more profitable company.
Do we know what kind of breakdown they want between the advertising business and the retail side, which obviously features much thinner margins?
Well, as a rule of thumb, the advertising business can carry a margin of up to 80%. When you're talking about the retail business, you're in the teens, and on an operating margin perspective, you're in the low to mid single digits. So it is a very important component of their long-term strategy. Other businesses like fulfillment services, which is increasingly important with their e-commerce operations, are also higher margin. And so when you start to bring multiple businesses with higher margin profiles in, it really does change that entire framework.
Yeah, that's a really important point. But I mean, I guess we go back to the main point, which is that as the world's biggest retailer, Walmart has access and has a window into the consumer that no other company does. The key comment I saw in the earnings release was that we are not seeing any incremental fraying of our consumers' financial health. You mentioned a little bit earlier that they are attracting more customers in times when when things are a little bit tougher. It's harder for the consumer. But who exactly is the consumer right now? How much trading down is taking place? Or is that something that we're going to see in the coming months?
Well, I think if you look historically, Walmart's core customer was always the lower income to middle lower income consumer. They're bringing in slightly higher household incomes, and that may actually be a bigger threat to companies like Target, which tended to have a higher income core consumer. What's interesting about Walmart is that it's not just about price; it's also about things like convenience. The uptake of their online order and having it delivered or having it pick up at the curb, that growth is really showing that regardless of your income level, consumers are looking for more than just price. And that is part of what makes it a longer term story, so that when the economy gets better, people don't need that really cheap price, but there are other things that still keep them engaged with that ecosystem.
Very well said. Bloomberg Intelligence Senior Analyst Jennifer Bartashis, thank you so much. We're going to stay with retail here because big picture, July sales rose well above estimates by about 1%, highlighting consumer resilience, even in the face of, well, still elevated prices and borrowing costs. So joining us now for more on the retail sector overall is Dana Telsey. She is founder and CEO of Telsey Advisory Group. Dana, thank you so much. I know that we're just talking about Walmart, and you don't cover Walmart specifically, but I'm curious to get your take because the CEO of Walmart, Doug McMillon, says that we aren't experiencing a weaker consumer overall. They want value. They want a broad assortment of items and services. Is Walmart an outlier here, or given what other retailers have told us, have shared with us?
You mentioned at the beginning, Walmart's the biggest retailer out there, and I think they're gaining share. I think the share gains that they have, given the extensive reach they have into many different income cohorts right now, plus the fact that look what he said about ticket and traffic both showed gains. So I think they're gaining share from others. The value pricing that they have, the convenience, whether it's in-store or online, coupled with the broad category assortment, and look what he said about back to school. Back to school is strong for them. I don't think the words that, and frankly, the picture that we're seeing from Walmart, we're going to hear from other retailers. It feels like they're stronger than others because of their offering, their price, value, and convenience relationship.
Yeah, but then we're just hearing from Jen Bartashis that it's not just about price. It's convenience, as you mentioned. It's about the value proposition they offer overall. Is this something that other retailers can kind of present themselves as offering, or are certain brands just seen as in a better position to benefit when consumers are fatigued of high prices and are looking to seek out better pricing, better value?
I think overall, you're seeing that shift to value. You're seeing it with the off-pricers who will begin to report their earnings next week. And then the other types of shopping, I think there's intentional shopping being done by consumers that are focused on particular brands that have innovation and offer something new and different that consumers are willing to open their pocketbook for. So it's value and it's differentiation with innovation that leads to that intentional shopping.
One thing that the CFO of Walmart did mention as sources of uncertainty are the upcoming elections and the unrest in the Middle East. I'm curious to get your take. How does this affect consumer behavior? And is there any way for these retailers, these merchants, to kind of get ahead of that?
I think one of the things we're seeing retailers do in response to what is an uncertain, whether it's political or geopolitical environment that's out there, look how they're managing their inventories. You're not hearing of inventory increases. You're hearing definitely of inventory moderation. So leaner inventories allow you to manage your margin. And you've seen almost more confidence in the margins than you have in some of the sales, given the volatility. Going into election seasons, we did a piece looking back at the past 13 elections. What typically does best for consumer stocks is incumbents and Democrats. We'll have to see what that brings this year as we go through the election cycle.
So what are the skills then needed for a retail CEO in this kind of environment with a consumer, again, fatigued with high prices, seeking value, seeking differentiation, seeking convenience, but also someone who's capable of managing inventory in a fast-changing world?
When you think of what drives success in retail and for brands, there's always three markers, and the drivers of them change. So the markers of concept, execution, and management are what deliver a successful brand and retailer. To have a successful concept is about innovation. To drive execution, it's about seamless and speed. And for management to have a vision for growth, it's data. So companies that have innovative product, that utilize seamless and speed enhancements, and that utilize data to inform are what's going to lead to growth. And I think that's what you've seen out of Walmart's results today.
All right, well said. Dana Telsey is founder and CEO of Telsey Advisory Group. She's going to stay with us as we also take a look at shares of Ulta Beauty, trading at the highest in almost 4 years. This is after 13F filings show Warren Buffett's Berkshire Hathaway has added a stake in the company. It's our stock of the hour. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for our stock of the hour, and we are watching shares of Ulta, which at one point today was on pace for its biggest rally since 2020. And why? Berkshire Hathaway disclosing a new stake in Ulta that's valued at roughly $266 million. When Warren Buffett gives his stamp of approval, the stock soars. Dana Telsey, founder and CEO of Telsey Advisory Group, is still with us, and she has an outperform rating on the shares. So, Dana, Warren Buffett likes Ulta. What about the stock screams discount and value in the Buffett sense?
I think in the Buffett sense, take a look at where the valuation of the stock is. The stock had been at nearly $600. Today it's trading, around $368, $369. So it's come down dramatically. I think the category is still a solid category. When you think about Ulta, it offers goods in the mass to prestige categories and price points. They just relaunched their own private label Ulta Beauty line, which accounts for 3 to 4% of sales. And Investor Day is coming up on October 16th, where they'll give out their long-term algorithm. Their footprint and their physical locations are convenient to consumers. And now with an even smaller box size of 5,000 square feet, we'll have to see what the expanded potential could reach. And the digital channel is also an opportunity for them. It captures the grandmother, the mom, and the daughter, and with services included, like hair salons, it brings people back. And let's not forget the Target partnership, which currently has room to expand into additional stores. It's in just over 500 stores currently.
Okay, that's a long laundry list of things to like about the company. We know that Warren Buffett doesn't time his stock purchases necessarily because he seeks out value, but thinking about the broader economy and how we're headed for a period of uncertainty and perhaps even a downturn, do you buy this idea of the lipstick recession indicator that when times get tough, people buy small luxuries like cosmetics?
Yes, I do. I think overall, what's happening with the cosmetics category remains strong. During the pandemic, it was a crazy Zoom cosmetics category because the growth rate for the industry was up double digits. It's normalizing now back to around mid-single digits. But you look at that in comparison to other categories, and that's still strong growth. However, one thing to note, there's expanded distribution points. Whether you have companies like Sephora and Kohl's, obviously you have Ulta and Target, there's been more distribution points for beauty. Even the off-pricers having more beauty assortment in their stores. So that's the competitive force. With Ulta's loyalty program, they need to keep enhancing and refining to be the destination of choice.
I want to talk about another company that's also gaining, outperforming the market. Tapestry is up by 3 1/3%. You have the lower end, which you could argue is cosmetics because low price point, and then you have the higher end. So it really gives weight to this idea that we're in this K-shaped economy where high-end stuff does well and low-end stuff does well too. When we look at Tapestry, the earnings came in better than analysts had anticipated, despite warnings from other luxury purveyors that perhaps things were slowing down. What is Tapestry doing right?
A couple things. Remember what we said before, product innovation. Innovation in the Coach brand is working. Their price points are not at the upper end of core luxury. Even some of their newer product innovations like the Tabby handbag was placed into some of their outlet stores at full price and exceeded plan. Their gross margin was up 600 basis points over 2019 levels. But what everyone wants to know about Tapestry is what's going to happen with the potential Tapestry-Capri combination. On one end, Tapestry just said today that they continue to remain fully embrace that acquisition, and they see the opportunity for it to be accretive to Tapestry's baseline with the high teens operating margin, even at depressed sales of the Michael Kors business, and more than $200 million of synergies. While if it does not go through, you have an excess cash flow generator at Tapestry of around $800 million. The potential for a share buyback definitely exists. So the strength of the Coach brand, along with the potential buyback. Well, keep in mind, Kate Spade and Stuart Weitzman, not performing at the same levels of Coach, and there's work to do.
Right. And I know that Coach was able to raise prices and still hold on to its customers and boost sales. You mentioned Capri, 7th straight decline in annual sales, and that was what the company had told us. Even if Tapestry wants to move forward with it, is it in a position to get a lower price now, renegotiate the price point?
It's been asked millions of times. They haven't made any comments on it. It'll be interesting to see if the deal can get approved from the FTC, and then we'll hear more. Right now, they have the financing in place at that price point, so let's see what changes.
All right, Dana Telsey, always a pleasure speaking with you, and thank you so much for an extended conversation with us. Dana Telsey is founder and CEO of Telsey Advisory Group. Coming up, we're going to move on to the world of higher education because a third Ivy League college president has resigned as a result of the campus protest war over the war in Gaza. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Columbia University President Manu Shafiq is now the third Ivy League leader to resign as universities across the U.S. grapple with protests over the war in Gaza. Bloomberg's Katya Porzakansky reported on this, and she joins us now. So it's been a quiet summer. There hasn't really been any protests. I mean, even the protesters need to go do their internships. So why now? Why is she stepping down now?
That's a good question. And I think a lot of us are wondering that. There doesn't seem to have been a sudden reason for it. And it does seem to be a surprise. Her resignation was a surprise to faculty, students, and the board. But we know that school's about to start in 3 weeks. We know that Columbia hasn't really figured out a plan yet. There's talk about giving their public safety officers a little bit more powers to arrest students. Right now, they can't even touch students. We know that they've clamped down on the campus, on access to campus already a couple weeks ago. We know there's already been threats from the protesters to bring it back even harder this time. One protester said that an encampment is now the baseline for them. So we know things are going to be heating up really soon, and Columbia doesn't really have a path forward to buckling down in terms of protecting student safety or also catering to the free speech wishes of some of the protesters.
So, yeah, I mean, the October 7th anniversary is coming up in the fall, so that will definitely be something that people are on the lookout for. I mentioned she's the third Ivy League president to do so. You had UPenn's Elizabeth McGill and Claudine Gay of Harvard. Coincidence or conspiracy that these are all women?
Well, I mean, I don't know.
I'm not feeding conspiracy theories.
There are also people who testified in front of Congress and said things that were not well received. With Manu Shafiq, she is dealing with. She had a much better time in front of Congress, but still dealing with a lot of accusations that it has gotten out of control on campus in terms of anti-Semitism. The Anti-Semitism Task Force did an analysis, and they found hundreds of cases of people who have had felt discrimination, and also professors that have told their students that they would get extra credit if they participated in these encampments and protests, which if you are a Jew student or an Israeli student, probably not a great feeling.
So you mentioned the congressional hearings and how all three of them spoke before Congress. Elise Stefanik, the congresswoman who kind of led the charge on this, has been very vocal about wanting to bring down a lot of these university presidents. And I think she even tweeted after Manu Shafiq stepped down, she's saying that there's still more to come. This is part of now a bigger culture war, but what specifically is she looking for from these schools?
I think it's hard to say, what exactly she's looking for that isn't politically motivated. I mean, I think there's also political motivations to a certain degree, but I think in general, strong stances against not only protesters, but general discontent on campuses that is making a lot of Jewish students feel unwelcome. And you're also talking about civil rights violations in some cases, students that are unable to participate in campus activities. You have a judge that now just said to UCLA they need to protect the Jewish students who are blocked from accessing campus at all. That, you're talking about federal funds. And Congress is in charge of making sure
that's a good point
that these schools are abiding by their civil rights obligations.
Yeah, otherwise they'll close the spigot, basically, in terms of federal funding. Katya, always a pleasure. Katya Porzakhansky here with us on the resignation of Columbia University's President Manoush Shafiq. That does it for me. I'm Scarlett Fu, and for Bloomberg Markets this hour, we're keeping an eye on the gains in equities on the better-than-expected retail sales report. This is Bloomberg.